You've probably heard about dollar cost averaging, or DCA for short, and are wondering what to do with your savings. So is it the holy grail for beginner investors? Well, no. If you plan to invest for the long term and you have a lump sum of savings available, studies show that you are better off investing that lump sum in one go. However, with DCA, you are able to invest in the stock market without having to worry about timing the market perfectly or making any investment decisions. And today I will show you how. Get ready and buckle up. Well, hello, financial fluxers. Welcome back to another power-packed session on Cash Capacitor channel. I'm Doc Brown, and I'm here to present what they should have taught you at high school and college, but they didn't. In this video, I'm going to explain everything you need to know about DCA, including what it is, how it works, the benefits of using it, and how to get started. Stick around to the end of the video to learn about bonus tips on how to make dollar cost averaging even more effective. Grab your notepads and smash that thumbs up if you are ready to level up your finance game. And now, let's kick off this thrilling journey and get right into class. First, let's define dollar cost averaging. Well, it is an investment strategy in which you invest a fixed amount of money at regular intervals, regardless of the price of the investment. This means that you will buy more shares when the price is low and fewer shares when the price is high. For example, let's say you decide to invest $100 per month in a stock using DCA. If the stock is trading at $20 per share in the first month, you will buy 5 shares. If the stock falls to $10 per share in the second month, you will buy 10 shares. And if the stock rises to $30 per share in the third month, you will buy 3.33 shares. Over time, this strategy will help you to average out your purchase price, which can reduce your risk and increase your potential returns. Here's my first example to show the power of DCA. Let's say that you started investing using DCA, buying for $100 of shares on the first of each month in a single company like Amazon, starting 10 years ago, October 2013. 10 years later, in October 2023, your investment would have been worth over $30,000. And the only thing you had to do is make sure that each month you have that $100 available, nothing else. But let me show you why dollar cost averaging actually works. Dollar cost averaging reduces your risk and increases your potential returns. When you invest using DCA, you are buying shares on fixed regular intervals. Each week or month you invest the same amount at the same time. This means that you are not trying to time the market, meaning trying to analyze yourself when it is the right time to buy. In an uptrend market, you will see your average cost going up, but not as fast as the market price, meaning your profits are getting bigger. And vice versa, in a downtrend market, your average cost will be dropping, but not as fast as the market price, meaning your losses will be smaller. This reduces your risk, as data shows that people who try to time the market achieve smaller returns. Let me show you the power of DCA with a second example, but this time we'll invest in a market ETF, short for an exchange-traded fund. Let's say that you invest $100 per month in a market ETF using DCA for 30 years. Let's take VOO as an example, a well-known ETF by Vanguard representing the S&P 500 companies. This is less risky because you are investing basically in the top 500 companies in the US, instead of a single company like in the previous example. The choice is yours. If VOO would continue to perform as what we have seen in the previous years, with an annual average return of 13% since they started, the next 30 years of DCA investing would grow your investment amount to well above $400,000. If you would continue for another 10 years, you would even double that. So keeping a long-term view would certainly benefit your investment account, but there are more benefits you should be aware of. First off, DCA is a simple and easy-to-understand investment strategy. Secondly, it can help you to reduce your risk, as market volatility is not a big concern for DCA. Then let's not forget, it is a passive investment strategy, meaning that it requires minimal effort from the investor and you can just use your time to have fun out there. Finally, on a more serious note, it is a disciplined approach to investing, which can help you to stay on track with your financial goals. So how do we get started? Well, now that you understand the basics of dollar cost averaging, there are a few steps for you to take on your smartphone or laptop to set this up. 1. Choose a brokerage and set up your investment account. There are many different brokerage accounts available online with simple, straightforward registration. It's important to choose a platform that meets your needs. Some factors to consider include fees, trading tools, and investment options. For young beginner investors, you could review platforms like Stash, Acorns, Robinhood, or Webull. 2. Choose an investment. You can invest in a variety of different investments using DCA, like single company stocks, mutual funds, ETFs, or even crypto. They all have their own specific identity, with different growth prospects and risk profiles. So it's important to choose an investment that you are comfortable with from a risk point of view. Choose an investment that is liquid. This means that you should be able to buy and sell the investment easily. If you don't know what to choose, you should consider a market ETF like VOO. 3. Set up a recurring investment. Most brokerage accounts allow you to set up a recurring investment, which means that you will invest a fixed amount of money at regular intervals. You can choose to invest weekly, bi-weekly, monthly, or quarterly. This is a must-do step. 4. Fund your account. You will need to fund your brokerage account before you can start investing. You can do this by transferring money from your bank account. Link your bank account to your brokerage account first. This will make it easy to fund your brokerage account and to set up a recurring investment. 5. Start investing and enjoy the ride. Once you have funded your account and set up a recurring investment, you will start investing automatically. Don't worry about a long-term goal yet if you don't have one. Just stay disciplined and ensure every month you have an automatic transfer from your bank account to your investment account. Once all is set up, let DCA do its job and help to achieve your goals. DCA is often used when people want to accumulate a larger sum of money over a longer period of time, but it will not make you rich in just a few years. It can help, however, to get you ready for some of life's bigger financial challenges, like a down payment for buying your first home, some seed money for starting a business, or funding outside your 401k for additional retirement savings. To close everything out, let's take a look at our last example to show the power of DCA. Now we are going to look at something more interesting for our younger investors. Crypto, and especially Bitcoin or Ethereum, could be good candidates for long-term DCA. These assets are very volatile and have made very significant up and down swings. But if you use DCA, as I said before, these swings will be less severe to your account. Let's look at the past 5 years. Through all the ups and downs, Bitcoin achieved a compound average growth rate of 16% per year. Now let's say that you invest $100 per month in Bitcoin using DCA for the next 30 years, and Bitcoin continues its growth cycles. As in the past 5 years, your Bitcoin wallet would be worth over $800,000. Now don't get too excited. Investing comes with risk, and results from the past are no indicator for the future. However, your choices decide how much risk you will have to endure. For beginner investors, I can only recommend to start DCA by buying a market index ETF, like for example VOO. The cost for this ETF is very low at 0.03%, and you are spreading your risk over 500 companies in 10 different industries. And if you are very excited about crypto, then go ahead and take $20 of that $100 and invest it in Bitcoin using DCA. As we are getting to the end of this class, there are a few more things you should know about dollar cost averaging. Start investing early. The earlier you start investing, the more time your investments have to grow. Invest consistently with the same amount each time. Even a small amount like a $25 per month would be a great start. Every year review if you can afford to increase your DCA investment amount. Automatically reinvest your dividends. Make sure that the settings of your investment platform are set to reinvest your dividends, rather having the dividend paid out as cash. This will help your investments to grow even faster. Don't try to time the market. DCA is a long-term strategy, so don't worry about trying to buy at the bottom and sell at the top. If you are trying to time the market, you are not dollar cost averaging. Consider using a robo-advisor. These are automated investment platforms that can help you to create and manage a DCA investment plan based on a certain risk profile you choose yourself. They typically invest in a mix of stock ETFs and bond ETFs and charge a low management fee. If you're interested in this, you might want to check out robo-advisors like Sophie, Betterment and Wealthfront, which rated very high in recent reviews. You can find the links below. DCA is a particularly exciting investment strategy for young people because it is a passive investment strategy that requires minimal effort from the investor. Additionally, young people have more time for their investments to grow, which can help them to achieve their financial goals. Well, there you have it. Dollar cost averaging is a simple but powerful investment strategy that can help you to reduce your risk and achieve your financial goals over the long term. If you are new to investing, or if you have a limited budget, DCA is a great way to get started. Anyway, that's all for now. Thank you for joining us today. I hope this video has helped you to understand what DCA is and how it works. If you have any questions, please leave them in the comments below. Remember to like, subscribe, and share this video with your buddies. As you know, the YouTube algorithm loves that, and I would really appreciate it. If you want to see more about personal finance, investing, technology, and future finance, and all those finance things they did not teach you at high school, have a look around at the Cash Capacitor channel and check out the other classes. So this is Doc Brown signing off. Thank you for watching the Cash Capacitor channel, and see you in next class. So get your butts off that couch. Say goodbye to yesterday. This is you. Just do it.